You weren't supposed to see this pattern. Not in the headlines, not in the polished press conferences, not in the sanitized summaries designed to calm the herd. Because behind the January jobs report, behind the words stronger than expected, behind the neat little number that says 130,000 new jobs, something far more dangerous is hiding, and once you see it, you can't unsee it. The official story says the labor market is solid. Payrolls beat expectations. Unemployment dipped to 4.3%. The Federal Reserve holds rates steady between 350 and 375%. Traders adjust their bets. Markets breathe a temporary sigh of relief. On the surface, it feels stable, controlled, predictable. But financial power never reveals itself on the surface. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Because this isn't just about jobs. This is about positioning, about liquidity, about silent wealth transfers that happen while everyone argues about whether the economy is strong or weak. This is about how narratives are engineered to keep you emotionally reactive while institutions move strategically. January's job gains beat the forecast of 70,000. That's what the headlines amplify. But buried inside the same report are massive downward revisions to 2025. Average monthly job growth last year, just 15,000. That's not expansion energy, that's recession territory. That's an economy that nearly stalled while markets were still climbing. Now pause. Ask yourself why that revision doesn't dominate the conversation. Because revisions don't trigger FOMO. They don't generate bullish momentum. They don't spike retail buying behavior. But fresh headline beats, those create emotion. And emotion is liquidity. The Federal Reserve voted 10-2 to hold rates steady after cutting at the end of 2025. Inflation remains above target. So the official posture is wait and see. Futures markets now assign nearly a 40% probability to no rate cut in June, up sharply after the jobs data. The market hears rates higher for longer, but the elite hears something different. Higher for longer means controlled liquidity. It means pressure remains on weak balance sheets. It means speculative excess continues to be squeezed. It means only the strongest survive this cycle. And when liquidity is constrained, assets don't die evenly. They reprice violently. Here's where it gets uncomfortable. Last year's near-zero hiring wasn't random. Immigration slowed sharply, the labor force shrank, fewer workers means fewer jobs needed to maintain balance. So unemployment can look stable even when demand is fragile. That's a statistical illusion, and illusions are powerful tools. Kansas City Fed. President Jeffrey Schmid hints at structural causes, demographics, policy shifts, labor supply mechanics. Economists point to artificial intelligence adoption, corporate efficiency upgrades, companies producing more output with fewer workers, productivity rising while hiring lags. GDP expanded at a blistering 4.4% annualized pace in the third quarter. That's not recession data, that's acceleration. So which is it? A booming economy or a labor market barely crawling? When output grows faster than hiring, something changes beneath the surface. It means capital is being favored over labor, machines over people, efficiency over expansion. That is a wealth transfer mechanism hiding inside productivity. And wealth transfers are rarely announced. BlackRock's fixed income leadership pointed out that growth at this pace would normally require much stronger hiring. The divergence is unusual, possibly the early stage of a productivity-led expansion, or possibly the early stage of labor displacement. Either way, this is not neutral, because when corporations can grow output without hiring aggressively, margins expand, share buybacks continue, earnings per share hold up, equity markets remain supported. Meanwhile, wage growth pressure cools, consumer demand slowly compresses. This is how asset prices can float while the average household feels increasingly squeezed, and that tension is where cycles break. Fed Governor Christopher Waller warned that the labor market was weaker than widely appreciated and could deteriorate further. Low hiring, low layoffs, a frozen state. That kind of environment feels stable until it isn't. Think about it like ice forming over a lake. From above, it looks solid. Beneath, the water still moves, pressure builds, then one fracture spreads across the entire surface. Markets operate the same way. The January beat gives the Fed room to hold. Holding rates means keeping liquidity tight. Tight liquidity forces selective strength. Institutions with access to capital accumulate while weaker hands liquidate. And here's the part most retail investors never consider. When the Fed holds, volatility compresses. When volatility compresses, options premiums fall. When options premiums fall, positioning shifts quietly. Big money accumulates asymmetrically when fear subsides but uncertainty remains. They do not chase headlines, they exploit them. While you're debating whether 130,000 jobs is good, institutions are asking a different question. Where is mispricing emerging in a constrained liquidity cycle with structural labor shifts and productivity acceleration? That's a different level of thinking. Inflation remains above the 2% target. Currency purchasing power continues to erode slowly. Even if nominal wages rise, real value decays. That's currency debasement by attrition. Not dramatic, not headline grabbing, but relentless. And when real purchasing power decays, hard assets and scarce digital assets become alternative storage mechanisms. This is where crypto enters the equation. In a higher for longer environment, speculative tokens suffer. But fundamentally scarce networks, those become long-term positioning vehicles for capital that anticipates currency dilution over multi-year cycles. Crypto whales understand liquidity timing better than retail ever will. They accumulate when fear peaks. They distribute when narratives turn euphoric. They use macro uncertainty as camouflage. And right now, macro uncertainty is abundant. A labor market that looks strong on the surface, but was nearly stalled last year. Productivity gains that may mask labor fragility. GDP growth that contradicts hiring trends. A Federal Reserve balancing inflation risk against hidden employment weakness. That's not clarity, that's fog. And fog is where professionals hunt. Interest rate futures shifting from a 25% to nearly 40%. Probability of no June cut tells you sentiment changed quickly. Markets react to fresh data, but institutional strategies react to trajectory. Trajectory says, growth cooling, but still above long-run sustainable pace. Hiring weak beneath revisions. Inflation sticky, productivity rising. That combination creates a narrow corridor for policy error. If the Fed cuts too early, inflation resurges. If it holds too long, labor cracks. Either outcome introduces volatility. And volatility is not random chaos. It's a wealth redistribution engine. Retail investors respond emotionally to volatility. They panic sell weakness. They chase strength. They interpret media narratives as signals. But media narratives are reflections of price, not predictors of it. The human mind is the real battlefield. Fear compresses your time horizon. Greed distorts your risk perception. FOMO overrides discipline. Every cycle exploits those psychological vulnerabilities. When January's jobs report beats expectations, retail confidence ticks up. When revisions reveal prior weakness, confusion sets in. When the Fed signals patience, uncertainty grows. That emotional cocktail creates indecision. Indecision creates liquidity. Large players need counterparties. They need emotional participants. They need fear sellers and greedy buyers. You are either liquidity or you are positioned. The divergence between output and employment may signal the early stages of a structural shift. AI adoption reducing labor intensity, corporations optimizing aggressively amid tariff uncertainty, capital efficiency replacing workforce expansion. That means future cycles may not look like past cycles. In previous expansions, strong GDP meant strong hiring, meant rising wages, meant broad consumer momentum. Now, strong GDP might mean algorithmic productivity and fewer incremental workers. That changes political tension. It changes consumer psychology. It changes asset allocation preferences, and the market is forward-looking. If institutions believe productivity can sustain growth without explosive hiring, they will favor capital-intensive sectors. Technology, automation, infrastructure, scarce digital networks. Meanwhile, labor-sensitive sectors may lag, but here's the twist no one says out loud. If productivity gains mask underlying fragility, then the first crack in output growth could expose just how thin hiring really was. And if that happens while rates remain elevated, the adjustment could be sharp. This is why elite positioning happens before confirmation. They do not wait for official recession declarations. They do not wait for unemployment to spike visibly. They watch liquidity flows, credit spreads, earnings revisions, real yields. They position when probabilities shift, not when headlines scream. Right now, probabilities are shifting. A low hiring, low layoff environment is inherently unstable. It relies on corporate confidence holding steady. It relies on credit markets staying functional. It relies on consumer spending not cracking under inflation fatigue. Remove one pillar, and equilibrium collapses. The January report buys time for the Fed. Time is valuable, but time also allows silent accumulation. When markets believe the Fed is on hold, volatility subsides. When volatility subsides, complacency grows. When complacency grows, leverage builds quietly, and leverage always reveals itself eventually. This is not a prediction of immediate collapse. It's recognition of a phase shift. Asset repricing cycles don't announce themselves. They transition. Slow labor growth through 2025. Productivity surge. Above-trend GDP. Sticky inflation. Rates held steady. Futures markets divided. Policymakers split. That is late cycle complexity, and complexity is where misinformation thrives. You are told the economy is strong. You are told it is slowing. You are told AI is boosting output. You are told labor is resilient. All of these statements can be technically true while collectively masking vulnerability. Truth in markets is multi-layered. At the top layer, January looks solid. Beneath, last year, nearly stalled. Beneath that, structural demographic shifts distort metrics. Beneath that, capital allocation shifts toward automation. Beneath that, currency slowly debases. Beneath that, global liquidity ebbs and flows in cycles larger than any single jobs report. If you only see the top layer, you are reacting. If you see deeper layers, you are anticipating. And anticipation is power. When inflation sits above target, every month of holding rates transfers wealth subtly from borrowers to savers. But it also pressures governments carrying massive debt loads. Interest expenses rise, fiscal stress builds, political incentives shift toward eventual easing. Markets know this. So even when the Fed says higher for longer, long-term capital evaluates sustainability. Can rates truly remain restrictive indefinitely? Or is this another controlled squeeze before a pivot engineered under stress? The pivot, when it comes, will not be charitable. It will be strategic. Liquidity injections never happen at peak optimism. They happen when pain forces action, which means if you are waiting for certainty before positioning, you are late. The real question is not whether January's jobs were strong, it's whether the underlying structure of growth is durable without broad hiring expansion. If growth depends increasingly on productivity gains and capital efficiency, asset ownership becomes even more critical than wage growth. That's the silent message. In a world where fewer workers are needed to generate output, those who own productive assets win disproportionately. Those dependent solely on wages face compression. Now, that dynamic fuels inequality, it fuels political tension, it fuels regulatory shifts, and it fuels demand for alternative systems, including decentralized finance structures. Crypto is not just speculation. It is a response to perceived systemic imbalance. When people feel traditional pathways are narrowing, they search for asymmetric opportunity. Whales understand this psychology. They position during macro uncertainty because that's when belief systems fracture. Right now, belief systems are fracturing. Is the labor market strong or weak? Is AI empowering or replacing? Is inflation controlled or persistent? Is the Fed cautious or behind the curve? Ambiguity creates volatility potential, and volatility is a ladder. Some climb, some fall. So here's the warning. Do not anchor your financial worldview to single data points. Do not allow headline beats to override structural analysis. Do not let fear during downturns or greed during rallies dictate allocation. Understand liquidity, understand positioning, understand that revisions often matter more than initial prints. Most importantly, understand that markets are not moral. They are mechanical. They reward discipline. They punish emotion. January's job gains give policymakers breathing room. But breathing room does not eliminate fragility. It postpones resolution. And postponement can amplify impact. When cycles finally resolve, they do so with force. You are living in a period where output growth, labor dynamics, inflation pressure, technological acceleration, and monetary policy are colliding simultaneously. That collision will redefine asset pricing over the next decade. Some will see it as chaos, others will see it as opportunity. The difference will not be intelligence alone, it will be psychological control. Can you stay rational when media narratives swing? Can you accumulate when fear spikes? Can you hold when volatility tests conviction? Because institutions are counting on you not to. They are counting on emotional capitulation, on herd behavior, on predictable reactions. Break that pattern, and you stop being liquidity. You start being strategy. The January report is not the story. The divergence is the story. The revision is the story. The structural shift toward productivity over labor is the story. The Fed's delicate balancing act under inflation pressure is the story. And the hidden story beneath all of it is control. Control of liquidity. Control of narrative. Control of time horizons. But you still control your mindset, and that is where every financial war is won or lost. The next few quarters will test assumptions. Growth may cool, hiring may wobble, inflation may surprise again, rate expectations will swing, markets will react. When they do, remember this moment. Remember that the strongest players position before confirmation. Remember that wealth transfers happen quietly before they become obvious. And ask yourself one question. Are you reacting to headlines, or are you reading the layers beneath them? Because once you see the layers, you can't go back. This isn't about fear, it's about awareness. It's about understanding that economic data is both information and instrument. That policy is both stabilizer and signal. That markets are both pricing mechanisms and psychological theaters. You are inside that theater right now. So here's the final truth. The economy may look stable, the labor market may look resilient, rates may look steady, but beneath that surface, positioning is happening. Liquidity is shifting, productivity is reshaping power, and the next repricing cycle is already forming in the shadows. Most people will never understand this. Will you? Drop a comment and tell me. Do you think the labor market is truly strong, or is this the calm before a major reset? Send this to someone who needs to hear it, and if you want to stay ahead of the next shift before it hits the headlines, subscribe now and turn on notifications, because the next layer is already moving.